I am Naina, moderator for this conference call. Before we begin with, I would like to extend my warm welcome for joining us today for the discussion on the financial results for H1 financial year 2021 and addressing investors and analyst queries. On board, we have with us today Mr. Vineet Agarwal, Managing Director, TCI, and Mr. Ashish Tiwari, Chief Financial Officer, Group. At this moment, all participants are in listen only mode. Later, we'll conduct a question and answer session. At that time, if any participant has any question, they can use the raise hand feature in Zoom call and wait for her turn to ask the question. Please note that this conference is being recorded. I would now request Mr. Ashish Tiwari, Group CFO, to embark on this meeting. Thank you, and over to you, sir.
Thank you, Naina. Good evening, ladies and gentlemen. Again, I am welcoming you all to this earning call for FY21 first half. Today, we will begin with opening remarks from Mr. Vineet Agarwal on the business and the industry, followed by our earning call presentation. I hope that you would have got the copy of the same along with the invitation. It is also available on the our website tcil.com. Now I will request Mr. Agrawal to just give us opening remark. Thank you.
Thank you. Ashish, can you please put up the presentation? Good evening and thank you for coming today, joining us today at for our earnings call, for our 6-monthly earnings call. It's a difficult circumstances, but we are all here and we are here to answer all the questions that you might have related to our business. So let me start off by first talking a little bit about what is TCI for some of you who have joined us for the first time. And then I can get into specifics related to divisions or what has really happened in the last 3 months. So TCI is a 62-year-old organization, and it's a group with moving more than 2.5% of India's GDP. We move through about 12,000 of our own trucks, and we have about close to 7,000 people on the payroll. Next slide, please. This is the group overview in terms of the divisions as well as the joint ventures and other group companies. So there are 3 major divisions, which is the Freight Supply Chain Solutions Seaways, and 2 joint ventures, which is Concor. We have one for rail logistics with Concor and with Mitsui for automobile logistics called Transsystem. We have subsidiaries of called TCI Cold Chain, and subsidiary in Bangladesh and a subsidiary in Nepal, and group companies of Express and Developers. Next slide, please. We have a very illustrious board with many people from different walks of industry, different industries, and which helps us to really look at things from different perspectives, as well as ensure that we keep up with the highest corporate governance standards. Next slide, please. Again, as a company, we are a thought leader as well, with a lot of our publications that really go out to the market as well as to the industry, and we also are a benchmark in many ways. Next slide, please. The logistics market size, as you all know, has been growing and is typically grows in line with GDP growth. But in the last few years, the kind of growth that we've seen in this industry is more towards the formalization of the industry. More specifically with GST coming about, we are seeing that the fragmentation, though it still exists, it means that there are opportunities for larger companies to operate even more and more. And we operate in various segments from our FTL, LTL, rail, 3PL, and shipping, which is mostly coastal shipping. Next slide, please. So in the last few months, of course, being a very, very challenging time, we've been able to ensure that we've been very responsive, not just towards our employees as well as, but also towards our customers. So, from an employee perspective, we have not cut anyone's salary. We have not removed any person from the organization, and we've also given the bonus that is typically due at this point in time. And we are also in the process of considering an increment for the year, because we feel that this is the time when a lot of employees have stood up and been on the ground and assisted our customers in getting their cargo moving, in terms of getting their warehouses operational and so on and so forth. So this is a has been an excellent time in terms of employee um, uh, response, and we want to also clearly recognize that fact. From a customer perspective, the huge number of calls that have been made, the emails that have been sent, the virtual video conferences that we have done have ensured that we have a very solid pipeline that is coming for the next few months, as well as our receivables have been also it has been in good shape. So we are using this particular connect that we made with customers and see how we can leverage, not just now for this financial year, but how we can look at the next financial year and growth going forward. From a vendor perspective, we've not held anyone's payments and made every payment on time and before time in some cases, to ensure that we are able to get the support from vendors, be it at a labor and warehouse level, where we are operating for, let's say, e-commerce players, and they've really scaled up and they want more and more people to assist in the operations, or from our vendors who operate trucks for us in many places. So we've been able to use that and respond very quickly to all our customers. Next slide, please. So in terms of growth drivers, some of you must have seen this from the last quarter's presentation rather. There are sectors that are seeing tremendous growth, like the agricultural sector, food processing sector, pharmaceuticals, chemicals. And of course, there is some shift that is started to happen towards different modes of transport. So it's not just the road transport, but rail and coastal shipping is also picked up quite a lot, especially when we are seeing in the food, grain movement, etc. Since the government has mandated that for free food grains till the end of this month, if I remember correctly, um, that has really helped in procurement and movement via using different modes of transport. We've also seen in this period now, at least in the last 2 months, stocking and restocking taking place on the automobile side, on the retail side, and certainly on the e-commerce side. Huge amount of growth has been witnessed. All our customers are demanding additional space. Well, in some cases safety stock, a few cases where they have looked at consolidation, but definitely looking at larger warehouse spaces. In terms of long-term drivers, we definitely believe in the India story, not just because of the fact that we have a large domestic market, but also there is a possibility with the government's intervention, using things like the PLI, production-linked incentives, and others, to attract the global value chains to India. And when that starts happening, we as a company should also benefit in some form or the other for logistics. Other trends that are very visible, other than e-commerce, of course, is the omni-channel. Even this festival season, we've seen a lot of people have perhaps gone to markets, seen things, but really gone back home and ordered things online. Or maybe has seen some ad somewhere and ordered online. Or seen some online ad and ordered offline, gone to the store. So various omni-channel aspects have been very, very visible in the last few months. I mentioned a little bit about multimodal transport, and specifically on digitization, we are seeing a lot of initiatives by the government, and we as an organization have also been involved with the Ministry of Commerce, where they have a logistics secretary and a wing in trying to see how we can digitize a lot of the processes to make things from an ease of doing business in India better, how can it be streamlined and smoothed? So there's a lot of activities already happening in that space also, and we think those are also great drivers for us as an organization. Next slide, please. On the broad USPs that we have versus many of our competitors is the ability that we are providing a huge range of services, the diversified operations. And we've seen that specifically during this pandemic, that we were able to deliver using these various modes of transport, having the range of services from a basic transport to complex warehousing as well. Next slide, please. Amongst the other capabilities that we have in terms of complete design of supply chains, and we are seeing that some customers are coming to us and saying that, can you do this for us? Why don't you add this additional aspect? And we are seeing that that scope is just going to grow and accelerate. We also couple this up with our digital solution so that we have a platform where they can also view all of these things that we are doing, uh, and accordingly the interaction for us is more digital as we go forward. Next, please. As a company, we've always believed in the light to medium asset model, and I think that is mostly visible. So, if you see our freight business is on a light asset model, and our shipping business is on a heavy asset model, and the supply chain is somewhat in the middle. And this has had a good benefit, specifically even in this time where we've been able to bring some of our own trucks to operations where we've have not been able to find market trucks. And on the other side, some of our competitors have really faced challenges to have when they have had too many trucks, because that has been difficult to control, not find drivers, and not get those trucks on the road. We've also seen this is a time when some of the suppliers do have come together, the vendors, and have cartelized. So, in several cases where companies have no assets, we have seen that happen as well. And we think that the model that we have adopted from a light to medium asset should help us in the long run. Right, please. I mentioned about multimodal transport. I cannot emphasize more and more about the impact of this now. The growth in this area is immense. We are seeing a lot of demand for our services, be it on the coast, be it on via rail, and a combination of road, rail, sea. We've been accelerating this growth opportunity by putting in more people, business development teams, and also solution development teams, because sometimes the customer is not clear as to what is how can they move towards multimodal transport. In fact, just before this call, I was on a call with a particular customer, and they have movement of fly ash, for example, and they are saying that how can you use fly ash through a multimodal network, because today fly ash moves on a regular rail network, and it tends to fly off, and it's an environmental concern. So can you put some liners or something to design a solution using containers so that we are able to not only move it multimodal but also be environment friendly? So like this, we are seeing a demand for lots of different types of industries wanting to use multimodal transport. Next, please. From a warehousing perspective, we've rapidly increased our footprint where it comes to not just the closed warehouses, that is the inside the box that we call, for not just e-commerce companies, FMCG companies, and so on, but also build large yards across the country. And wherever our customers feel that their production, to get the production there locally to their dealers, etc., is going to take time, we've created yards for them. And this has really helped because customers have been able to capture sales at the right time, and also to make deliveries to their further customers very easily. In some cases, customers have also bypassed dealers because it is easy to bill directly as well to customers and save that extra margin. So we are seeing this as a good growth area of creating these multiple yards, and that in coupled with a multimodal network of, let's say, using in the automobile space, the rakes that we have for movement of cars, etc., is creating a unique network which is of multimodal in nature, which is also quite and is also sustainable for the future. Next, please. From a basic freight perspective, we are amongst the few companies who have a national network which handles all LTL and FTL. In this time, some of the large customers have also looked at a more frequent movement of cargo versus just FTL. So we have helped them in many of these using our hub centers. And though some SMEs, MSMEs have taken a little longer to come back on track, but otherwise we are seeing that our LTL business is almost back to normal at pre-COVID levels. Next, please. I mentioned a little bit about technology in terms of what we are doing. Next, please. So in the first half of the year, we have lost about a quarter of sales as compared to the last financial year. Obviously, this is mostly because of the last first quarter of this financial year. Profitability is a little bit lower, at about a third lower compared to last year. But the last quarter, Q2, has been quite robust, as you've seen, and we expect this to continue. Next, please. This is division-specific financial results. And if I want to specifically talk about what's happened per division, from a freight business perspective, we have seen that volumes have come back in Q2, and we are at just 9% negative over the last financial year. Though the margins are slightly better, and we see that this trend should continue in terms of business growth as well. So some industries have picked up, specifically on the textile side, a little bit pickup we are seeing, because of restocking that has happened. A lot of the dairy product movement, food grain movement, some metals movement, all this has happened in the last quarter a lot more, and hence we are able to catch up to a great extent. LTL business still is lesser than the 33% in the last financial year, but we expect to catch up going forward as well. The other, if you just go back, Ashish, I think the other thing that we are seeing here is, of course, the freight rates are started to move up a little bit because of the fuel price hikes that have happened, or rather, fuel prices have not come down. So demand has been higher, and hence some stretching has happened on the rates as well, freight rates. Though we feel that this will also keep growing because freight rates will keep increasing. Capacity expansion has not happened too much. A lot of capacity has been recycled, or rather, second-hand sales of trucks, etc., are much better than primary sales of long haul trucks. We've seen good growth in the short haul and the medium haul, but not necessarily in the long haul in this 6-7 months in terms of sales. So the next 2 quarters could be slightly tight from a cost perspective, but that is mainly to be seen in terms of how much capacity expansion happens on the purchase of new trucks. Next, please. On the supply chain side, you can see over quarter, we've had a 2.3% growth. And this is in line with the growth that we are seeing with the automobile sector. As you know, this division has about 80% of our business comes from the auto sector. Of course, growth in e-commerce, in warehousing, and other areas have also helped us keep up the growth. And we are quite confident that we will make up the lost quarter in this financial year itself. Overall, as you also know, that we've added 2 rakes for automobile transportation in this space. and that has started to also give us good results. On the Seaways side, volumes are higher than last year by about 9% odd. This is because of an addition of one ship that happened last year, so over last year we are seeing that benefit in this quarter. But one of our other ships was also under dry dock. We are still seeing high demand from the Western sector. One of the ships that we were planning to buy in Q2, we've not been able to purchase, but we're looking to get this possibly in Q4. So that was more or less in line with what we've been saying of adding a new ship between every 12 to 18 months. So here the trends are very positive. Fuel prices have also come down quite substantially over the last 6-7 months. So that is bunker rates, and that has helped us to ensure that we are keeping up the margins. Next, please. Our joint ventures, the rail business, as I said, the demand has been very high. So the growth in this half year has been almost 70% over the previous financial year, and we hope we can see that this growth is possibly going to continue with the demand that we have in terms of the pipeline, etc. So far currently. The cold chain business has grown about 21% odd in the first 6 months, and our trans-system business is down by half because of clearly because automobile sector has not done too well. Our debt equity ratio is very comfortable. We have been only utilize only under 50% of our working capital limits currently, and we've been able to reduce our debts by about 100 crores in this quarter as well. So you can see that the overall capital employed is also lower compared to last year in this period, and all the numbers seem to be good. We've also got a re-rating done, rather our ICRA rating A1 plus has been reaffirmed by them. Next, please. This is the overall results. Margins are more or less in line with, is slightly higher than last year, the same period, and revenues are almost at the same level. So as if I compare Q2 to Q2, but on H2 to H2 two levels, revenues is still down about 23%. So the other, in terms of guidance, what we feel for Q3 and Q4 is that overall, as a company, we should probably get to 80-85% of our FY20 levels, both in terms of revenues and in terms of profitability. The trends indicate that we should be able to get there. And depending upon how the last quarter goes, if you remember that we lost about 100 crores of sales in March 20 this year because of the lockdowns, etc. But hopefully, if things are okay, we should be able to make up some of that losses in this financial year and reach that 85% levels of FY20. So that's all I had. If you have any questions, please. We also the capex plan. Capex is at about 150 crore plan versus about 111 crores that we spent last year and about 30 crores that we spent in the first half. So we do expect about 125 to 150 crores of expenditure if we are able to purchase a new ship that is under plan. So if that happens, we should be able to get to 125 to 150 crores roughly. Thank you so much, and we are happy that you joined us. Please let us know if you have any questions. Thank you.
Thank you, sir, for the valuable insights. Ladies and gentlemen, we'll now begin with the question and answer round. If you have any question, you may please use the raise hand feature in call. I would request to start with your name and organization name, followed by your question.
Yes, hi.
So the first question comes from Mr. Preet Nagar Seth. Sir, please go ahead.
Right. Good afternoon, everyone. I would like to better understand, Vineet, if you guys are planning to take advantage of the vaccine opportunity that might be there, given that the cold chain business is growing. So if you can shed some light on that.
Certainly. So, vaccine logistics is an important factor, and we believe that the requirement will not be only from a cold chain perspective, but from an overall maybe warehousing perspective as well. See, we do not know yet whether the vaccine will be fully requiring a cold chain or not even requiring a cold chain, what aspects would be required. But we are definitely thinking about it and planning for the same. I cannot tell you exactly what we are doing, but we definitely have plans for it, and we've started our work already and created the capacity.
Okay. Alongside that, could you also shed some light on the cold chain business, where you say that you feel this could be a long-term driver for the business? I think in the last call. So, given that the agri reforms have come in, how do you see cold chain developing from here?
So cold chain is a very interesting business because in the last 10, 12 years, the amount of capital that has come into this business has been huge from a PE perspective. And that has meant that we have overcapacity in some areas of cold chain. So what our strategy has been that we are not going ahead and buying more and more trucks or creating new warehouse capacity, etc. But we are going in a manner of using some strategic assets, as we do with all our other businesses, that create some strategic assets, but also a lot of vendors or companies that we can get from who can work with us together rather than owning those assets. And the growth areas that we've seen, we've started work for a cloud kitchen or a dark kitchen, as they call it. We've started work in the area of an FMCG company. We started in a chemicals company. All these companies require cold chain, and we see good growth opportunity here. So definitely in the next few years, we see this as a growth driver for us. And simultaneously, when we are getting some customers, let's say the FMCG customer that I'm talking about, we actually have built a large warehouse for them, or rather got a large warehouse for them, which is a dry warehouse. So along with the dry warehouse, there is a cold storage warehouse. So like these kind of solutions that we are able to provide, we get a lot of inquiries, and hence it becomes a good driver.
Thank you, Vineet.
Thanks.
Thank you, sir. The next question comes from Sayan Das Sharma. Sir, please go ahead.
Hi, sir. Hope you are doing well. This is Sayan from Bobcaps. Sir, basically two questions on the SCS segment. First of all, if you can highlight individual segment-wise, how do you see the auto demand panning out? So across two-wheelers, four-wheelers, commercial vehicles, in individual segments, how do you see the auto demand? And do you see the recovery that we have seen over the last couple of months? Do you believe that is mostly a festive-led transient factor, or do you expect that to continue also? Would love to get your views on that, sir.
Sure. Thank you, Sayan, and hope you are well as well. What we have seen in the auto sector is that the demand has been high, and in some cases extremely high, because of the fact that many of them have launched new products, or there is restocking happening because of BS6. So something has definitely triggered that. Clearly, we also know that there are because of social distancing norms, there is a demand for smaller end cars, etc., or for bikes, which has increased quite a lot. So these trends are quite visible, and we are hopeful that this will continue, though there is some signs that it might not be that high, but I think right now the sense that we're getting is that post Diwali we'll get a better view of what is happening. But I think some of this will, you might see a slight dip in December because it's a model change year. As you know that we moved to 2021, so some companies might not, some people might not buy a new vehicle in December. But otherwise, we feel that it should continue subsequently. On the other segments in supply chain, e-commerce has been growing very rapidly. We've added more capacity also for many of our clients. And as you know, some of these guys are having not just now 2-3 day sales, but month-long sales. So month-long sales means that we are continuously active with our clients, and I think the only let up will happen post Diwali. So our teams are working at full tilt at all of these locations. On the FMCG side, the demand has been a little bit on the flattish side at the urban area, because we service mostly urban areas. Um, because I think in the past people have been stocking up adequately during the lockdowns, etc. On the consumer durable side, again, we've seen huge push. Specifically, I guess some of it was IPL driven, some of it was festival driven, some of it was just pent up demand driven, some of it was need based driven, which is essentially that I need another smartphone at home because my children need to study, or a laptop, and so on and so forth. So I think many of these things have happened, and that has pushed consumer durables to record levels at our warehouses also. So that's predominantly the main segments in supply chain.
Thanks, sir. Thank you for your elaborate answer. Also, wanted to get a sense on the supply engine segment, the non-auto segment. How has been the client addition traction, sir, during this pandemic? And now that we are somewhat out of the worst of the pandemic, do you see that there is a leg up in the number of customers that we are talking to, or we are adding in our client roster, sir?
Yeah, so we have client additions are high, as well as the same client also adding additional capacities also there. As we talk about, there are three types of clients. One is a client where in that addition, then in that same facility they're adding more capacity. So it could be a manufacturing plant that is ramping up their capacity, or in the same warehouse we are adding more capacity. The second is that client giving us a new facility or new location. So that's the other part. And the third is a brand new client. So in all the three areas, we've seen good growth. And I think it will continue. The traction is there more on the FMCG side, more on the chemical side, as well as on the latter, on the last case, which is new customers. And on the expansion side, more on the e-commerce type of businesses.
And one last question from my side, if I may. Uh, I mean, if I look at the based on the difference between the freight segment numbers on the consolidated statement and standalone statement, I see that the rail business seems to have done well. And you have also highlighted in your presentation that in H1 the growth has been 68%, which is pretty phenomenal. I understand that rail is growing faster than road this year due to multiple reasons. But what is actually leading that superlative growth, sir, in the rail segment?
So clearly, it's the fact that we are able to give them solutions to various aspects of their problems, and some of these solutions were given during the lockdown period when road was not available to them. So we've sort of made them aware of those solutions, delivered on those solutions, and that has made them very happy to work with us going forward. So what I mentioned previously is there is perhaps a permanent shift for some types of clients towards rail logistics completely, and that is one factor. Second is a lot of food grain movement has happened all across. I gave the example last time of a entity that we are working with in Rajasthan that has been contracted by the government to supply chana to South India. So they have contacted us, and we have moved that chana from by rail and then subsequently by sea to the south, to South India. So like this, food grain movement is the other factor that has been quite high. The third area that we work with in rail is also the metals and sorry, the chemical space. And there we've seen chemicals business has been robust across the country in all areas. So that growth has also contributed to some amount of growth for rail.
Thank you. Thanks a lot. That's it from my side. I'll go back to the queue.
Thank you.
Thank you, sir. The next question is from Mr. Srinivas Sheshadri. Sir, please go ahead.
Yeah, thanks. Hi, Vineet. Hope you're doing well. So first question is, again, just continuing on this, the Concord JV. It's good to note that even quarter on quarter it has grown. I mean, despite last time's kind of very strong scale up. One question there is that the margins are around 2% or so. So just wanted to understand if the business model is such that we basically our responsibility is more kind of the booking the business and then we get some percentage margin on that, or is there any kind of a scalability on the margin with respect to revenue going up?
Hi, Srinivas. So basically it's a volume game, and it's not just booking. I think the very important factor here is developing the right solution for clients, and that solution development takes a lot of time as well as a lot of engineering in terms of how we are able to provide those solutions, and then of course the execution. Because let's say a rake comes in, rolls into a plant, and there are 90 containers that need to be loaded, and then dispatched, coordinate with the railways, coordinate with Concor, coordinate with the client. So it's not so simple. We do a lot of handling also using stackers, reach stackers, and other handling equipment. And in some cases, when these rakes are going into ports for export, we also help in some amount of customs clearing as well. So it's quite a comprehensive and end-to-end solution. And some cases where the rake is moving directly from plant to the port, it's fine. But there are lots of cases where we have to do the first mile and the last mile as well. So that also adds to the complexity. Now, for all that complexity, the margin that we have is certainly is constrained. But with volume growth, we are seeing that this will start improving as well. Unfortunately, we have to get a fixed rate from railways, and that input cost doesn't change much. So it's only how much we can derive value from the customer by these value-added services will we be able to enhance the margin structure. And I do believe that this will keep increasing. The ROC on this business has already exceeded 25%. So from a return perspective, the business has become quite attractive.
Okay. And the ancillary services you talked about, that is being done by the JV itself, or that comes more directly through the TCI business?
So some of those services they outsource directly to the market wherever they find the cheapest possible solution, and in cases where they get value out of TCI, they will use that. So they work on arm's length basis.
Okay. No, what I was asking was, are these services being given by the JV or are this by TCI? I mean, apart from the transportation bit itself, whatever you talked about, in terms of the handling, loading, or customs clearance, and all those other ancillary.
Yes, they're provided by the JV. Yes.
JV. Okay. Sure. And second question was on this supply chain. Last time we discussed, you're talking about some kind of a sub-verticalization of the auto business and trying to get more customers and do better mining of those customers. So if you could give some broad update on what has happened during the course of, say, this particular financial year, in terms of what have been the wins. I mean, qualitatively, if you can talk about without naming, that'd be useful to understand how these efforts have panned out.
Yes, sure. So, like the segmentation that we have in automobile is the consumer side, which is the two-wheeler, four-wheeler. Then we have the agri side, and the third is the commercial side, which is the earth-moving equipment as well as the the earth-moving equipment and commercial vehicles. So I think what has happened in this course of this last 6 months is that all of these have had and that diversification has also helped us. So, in the beginning of the year, we had a lot of movement for tractors, etc. So, though April, May was very poor generally, but tractor movement was happening. As you know, agri sector was booming. So, we got that benefit. Then over the course of the last, in the middle somewhere, May, June, July, August, we saw movement of earth moving equipment companies where some road projects started. So there was some demand happening. There was some movement that happened to some of the border areas and so on and so forth. So we've been operational throughout on that. And then in this last half of the second quarter, August, September, and now on October onwards, we are seeing that the first element, which is the consumer automobile business, has picked up. Again, a lot of the business was at a minuscule level and has scaled up because they were not operational, or they did not have enough. They were not using enough capacity. But in net, we don't have many new customers. We have a few new customers, but mostly it is the existing customers that have picked up growth and have grown. So that is a continuing factor that we are seeing. And fortunately, with having all these three, our finger in all these three pies has helped us immensely in this period. And hence, you can see on the Q2, we actually had a positive growth over last year.
Okay, sure. Just one more question on the guidance, or I mean, I don't know whether you call it guidance or broad indication, but you said that you were kind of still hoping to reach about 85% level of last year, despite the second quarter having ended on a positive note. Now, if I look at how the second half had been last year, the second half also was not very good, and especially in the fourth quarter, because of the COVID, you lost some sales. So I mean, when I look at the ask rate for the second half based on, say, reaching 85% level, that implies a drop of nearly 12% in the second half versus the second half of the last year, which seems very, very conservative. So, I mean, I just wanted some view on whether are you anticipating any kind of headwinds in the third quarter or the fourth quarter beyond like what we see in the current numbers, which makes you quite kind of wary on still giving a very modest guidance.
See, I think what we don't know as to what kind of impact might be there on the both on the demand and on the supply side, because it's a very, very awkward year as you've seen with every customer. The rest of the world is also going through different second stages of lockdown, etc. We don't expect that to happen here, but at least there could be local level disruptions, which I talked about. Maybe it's when you have those demand and supply waves. So demand side, there could be some issues where some markets will not react, or suddenly people might say, I want to save more, and some negative sentiments might come about. And on the supply side, maybe factories get shut down because of COVID cases, and or areas get shut down specifically, but not largely. So what we feel is there is a lot of uncertainty, and based on that uncertainty, it is better to be slightly conservative and not go over aggressive. The second aspect is we also have to be very cautious about credit at this point, because there are lots of customers who are now just coming out of the moratorium, and there could be possibilities there where there could be challenges in terms of receivables. So there could be chances of more aggressive business growth, but we have to be careful not to really let our guard down and lose money eventually because of receivables. So that is a balance that we have to keep, and hence this slightly conservative note.
Understood. Okay, great. Thank you, and wish you the best.
Thanks, Srinivas. Thank you.
Thank you, sir. Next question comes from Mr. Prateek Kumar. Sir, please go ahead.
Hello. Yeah. Good evening, sir. My first question is regarding your employee cost. So that has dropped by around, I think, around 12%. We mentioned that we have not changed our employee base or changed salaries. So is there any other line item which has impacted or like resulted in cost savings year on year? And what is the more sustainable number going forward of this number? We should go back to 38-40 crore number on quarterly basis.
So employee cost on quarter basis is in fact slightly higher than last year. If you see on September of just the standalone was 1898 in September 19, and it is 19. Sorry, I think I was on mute. What I was saying is that employee cost is at September 19 on quarter 2 for the standalone is at 1898 roughly at versus 1983 in this current year. So we are already ahead of the last year's number on a quarter basis. Most of the impact happened in the first quarter of the year, where of course the CMD and the MD had not taken their salary, as well as there were a lot of long absentees, etc. And those people, and there were of course some people who have not joined back because they moved to their hometowns and so on and so forth. So I do not expect this number to sort of come down anymore. I think we have already started recruitment again because we are seeing growth potential. So both on the MBA side, we've recently given letters to almost 75 MBA students that we had interviewed pre-lockdown, and we've started getting them on board already. And at the lower level, we've also hired already almost 250 people, and that is directly on the payroll, and we are adding more people. So I don't expect this number to be lower anymore.
Pratik, are you there?
Mr. Prateek?
I think he's on mute.
The next question comes from Mr. Vittal. Mr. Vittal, please go ahead.
Hello, Mr. Agarwal. Thank you for the opportunity. Glad to know that all is safe on your side and hope it remains so. On the cold chain logistics, your sister's organization, TCI Express, in fact, your brother's organization, they also plan to enter into this stream. So will it be a joint venture between yourselves? How would it go? If you can throw some light on that.
No, it's impact there is that the cold chain business in Express is mainly related to the pharmaceutical business that they're already doing, mostly on the LTL side and on the small package size. So not really, and we are working together on it.
All right. Thank you very much. That's it from my side.
Thank you.
Thank you, sir. The next question is from Mr. Vivek Tulsian. Mr. Vivek, please go ahead.
Yeah, hi. You guys mentioned that the JV with Mitsui didn't do well because the auto sector has not done well. So, but on the overall SCM side, the revenue did grow. So, was that a particular client issue regarding the JV, which is why the numbers were weaker there, or on the overall basis also on the SCM side, our auto business has seen significant decline?
So yeah, overall business it is slightly lower in the but so what happened was in the the joint venture in the last quarter has picked up some amount of growth. The first quarter was, of course, very, very poor. But the last quarter, Q2, they picked up some amount of growth, specifically with clients like Toyota, etc., really ramping up their production and movement. But on a half-yearly basis, as you can see, that still there, that venture is at minus 50%.
Right. And could you talk a little bit about the e-com and the warehousing business? With the growth, what kind of growth we've seen for the quarter for e-com and FMCG, and now what is their share in overall SCM?
So we don't split up the revenues of the business-specific verticals in any of the divisions. But I can say that the growth, we operate about close to about 12 million square feet of warehousing space, and this is not just from a square foot perspective, but we're now adding capacity on a cubic foot perspective as well. So mostly the e-commerce warehouses are essentially fulfillment centers. So material comes in and we pick, pack, and invoice and keep it ready for dispatch. So that volume has been growing consistently. There are centers where we used to do about 25, 30,000 orders a day, have gone up to almost 50, 60,000 orders a day. So overall capacity has expanded. The number that you see in terms of square footage has possibly not increased because of cubic footage increase in terms of space.
Okay, thank you.
Thank you.
Thank you, sir. The next question is from Thank you, sir. The next question is from Mr. Alok. Mr. Alok, please go ahead.
Hello. Yes, sir. Good evening. Just a couple of questions. One is, if in this year we do not procure the ship, then what would be the capex, sir, for this year?
Without the ship, I guess it will be about closer to 100-ish crore.
Yeah, so Alok, the total capex plan is around 150 crores and ship is around 45 crore. So it would be 100 crore only, 100 or below 100 even.
Sure, sir. And sir, one question was on the SCM business. Post-COVID, like few months into the COVID, have we seen any new customers who were not really looking at complete supply chain solutions now sort of looking that, and have you added those to your client list? Have you seen any such trend happening?
Customers are talking about a lot of those ideas, and we've been also selling them, of course, for some time. And the way that we see that this happens is typically you take up one sector, one type of activity, and slowly start expanding into other areas. And this is typical, and this is what we've seen happen. There are customers who are talking to us from both an outbound and inbound perspective that we should handle the whole thing. But my sense is that it is not going to happen so easily. Possibly, you take up one sector on an outbound, one sector on an inbound, and slowly make your way through. So that is a typical trend. But yes, as I said, pipelines are very strong in terms of all of these customers.
Sure, sir. And sir, just one last question. If you could just elaborate on the freight rates you were mentioning, how has that moved for you in the last few months? And also related to that, how has been the driver availability now? And because we have heard that the people have paid like extra amounts to drivers to get them coming back. So your suppliers might have paid that and leading to higher costs for you. So what's the scenario now there?
So yes, we also paid extra because we also have 1,000-1,200 trucks on our books as well between all regions. So we also certainly paid extra when it came to getting drivers on board. and driver availability is before the lockdown was also a little bit of a stretch, and now also it is still a little difficult. However, we feel that this should start improving now, because there is the different kind of job opportunities that are limited at rural areas. So we should see people trying to come back and taking up the jobs that they were doing earlier. Freight rates will remain firm, is our view, because of we don't expect the government to really pass on the benefits of global uh, global fall in crude prices. So that would mean that fuel prices will continue to remain high and put pressure on freight rates, which should tend to keep moving up because of, as explained, one, demand typically going up in the second half of the year, and secondly, because of capacity expansion with new CVs has been less in the market. So if the government comes out with a scrapping policy, maybe we can see some amount of jump in CV sales. But otherwise, some sectors that you've seen CV sales growth, which is mostly in a closed user group, like a construction side or in a mine, or the small and medium sized vehicles growing because of the first mile and the last mile requirements. Those sectors certainly are seeing growth in CV sales. But on the long haul, high capacity vehicles, we've not seen much capacity expansion.
Sure, sir. Just one last question. In the SCM business, do you feel that you have seen any sort of pent up demand which might not be there, or which might just stabilize going forward in any particular sector?
Uh, no, I mean, pent up demand is still there. I guess consumer durables is still going through that phase, compounded by the festival season as well. And also now there are shortages of certain items, as you know, as like laptops and even television screens of a certain size, etc. So I think the that has not completely been exhausted, the consumer durables, and I think some behavioral changes clearly happened from an e-commerce perspective. So um, we certainly believe that the volumes that are there with because of perhaps because of festival season would possibly continue to at least 80-85% levels post festival season, also post these sales also, because of that behavioral change. In some cases, in the past, pre-COVID, typically after sales, if the sales used to be at a higher, let's say at 100%, post those sales, e-commerce activity used to come down to 50%. But I think this will come down to only about 80% this time around.
Sure. Got it, sir. Thank you so much, and all the best, sir.
Thank you so much.
Thank you, sir. This will be the last question of this earning call. And the last question is from Mr. Parimal. Mr. Parimal, please go ahead. Mr. Parimal?
Hello. Hello.
Yes, go ahead, please. Yes.
Okay, yeah. Thanks for the opportunity. I'm an individual investor since long time. I just wanted to know your thoughts on the dedicated freight corridor once it becomes operational, and about the coal chain you mentioned. There's excess capacity in the country, and how do we plan to go about it? If you can just highlight that. Thanks.
The first question on DFC is directly connected with the fact that we know that this is an area which has a lot of potential, and hence we got into the rail business 6-7 years ago, and the DFC will help us use the services of the DFC as a common carrier, and we will put our road traffic on it, clearly have rail traffic. So for us, it's a definite benefit rather than a negative factor. We also don't have any capacity that is running on that sector that will get redundant, etc. So that way it is quite good. So what was your second question? I'm sorry, I missed it.
And will it improve our margins with once it becomes operational in terms of efficiency wise?
So I'm not sure about the pricing structure yet, in terms of whether it will be substantially expensive. We know that they are going to carry double the length of containers at double stack at double the speed. So that's an 8x kind of an improvement on productivity and efficiency. But what is going to be the pricing impact? So we're not sure about all of those things yet. So very difficult to comment on the margin, but I do not expect it to really come down anyway. I think clearly it is something that should help us only as an organization.
And would the road freight get hampered with it?
No, the growth in the road business has its own dimensions. And I think, again, it's like first mile, last mile will still be needed by road. So some of that will still continue.
And the second is about a cold chain. You said there's excess capacity and you have some strategic decisions that you made about cold chain. If you can just highlight what do you mean by that? I didn't understand.
The strategic decision is not to invest into full creation of full capacity ourselves. Many of the companies that have done that have struggled with 100% ownership of warehousing space and 100% ownership of trucks. So that we believe is not the right strategy, because you also have variability in terms of temperature, etc. In nationally because of seasons. So utilization factors come down. Capex on this is quite high, so better to moderate it as well. And the third factor is how can you get return cargo, because not every location will you get return cargo for cold chain. So given all of these factors, we felt it is not necessary to own 100% of any kind of capacity, and that's the strategic framework that we work in.
Thanks for the thank you very much.
Thank you so much. Thank you.
This comes to the end of this earning call. Thank you so much for joining and gracing us with your presence. Stay safe and healthy. Take care.
Thank you, everyone.
Thank you, everyone, for joining call. Stay safe and healthy. Thank you.